Welcome to CurrencyCast. How do you manage cross-border investment projects that involve a large and potentially long-lasting currency mismatch? And what's the outlook for the multi-currency world? Welcome to CurrencyCast. My name is Austin McKinley. I'm the Senior Financial Writer at Cantox and your host. In this episode, we have the pleasure to welcome Jose Carlos Cuevas, partner at Crowe and board member of Asset and IGTA. Jose Carlos.
To be here with you.
Jose Carlos, so a warm welcome to you, and thank you for joining us in this episode of CurrencyCast.
Thank you. It's a true pleasure.
Right, Jose Carlos, could you start by introducing yourself to our audience, please?
Okay, listen, I start in a well-known Big Four audit firm, Coopers & Lybrand at that time, right now PricewaterhouseCoopers, in accounting and tax services. Afterwards, I spent, I think that 12 years. I moved to Treasury, and I became country treasurer for Spain at the Citroën, taking care of the industrial and commercial activities of the group. Afterwards, they invite me, quotation back, to move to Paris, and I decided to change and to look for a different company. I started working for Alstom. During 8 years, I became a regional treasurer Europe, based in sometime in Paris, but most of the time traveling, and taking care of the different activities regarding liquidity, FX, financing, and globally speaking, cash management. And afterwards, you know that Alstom Energy was acquired by GE, by General Electric. I moved to GE, taking a quite similar role, taking care of the energy part as regional treasurer for Europe. And after 2 years and being based in Budapest, I received an offer coming from a Spanish listed company, a 1 billion company, Duro Felguera, and they asked me to accept the role of CFO and senior vice president of corporate affairs, something like that. But at the end of the day, CFO, I was taking care of a quite difficult situation as far as the company was in full distress, with a high indebtedness, so many projects ongoing and in difficulties. So I had the responsibility of leading a capital increase during that time. And after 3 years, I moved to with a successful capital increase, I was all money and I need to move. And EY asked me to join the restructuring and liquidity department, taking care of working capital, restructuring, refinancing, and many other things. And after 5 years, I received a new offer coming from Crowe to create and to lead what we call transformation and turnaround. That is really, okay, listen, when you are in travel, in any kind of travel linked to liquidity issues, I take care of that. And this is what I'm doing right now. I'm leading that department, taking care of FX, liquidity, and distress, globally speaking.
Absolutely. So really an interesting CV, because you've been involved in treasury and finance operations, both at the operational level and on the consulting side. Is that right? So that leads us to our first question, which involves cross-border investment and infrastructure projects. Tell us, the perception is different when we discuss, a simple commercial transaction in the context of the currency risk, but the perception of a large, long-lasting investment project is that it's something really different. Before tackling the FX angle, guide us into the world of those cross-border international investment projects.
I fully agree that in fact, and regarding European and especially Spanish corporates, we are very focused on projects abroad because most of the infrastructure projects and most of the energy projects, globally speaking, take place abroad, and we need to start managing and taking care of issues regarding exotic currencies and countries in which, to be honest with you, the legal framework is not exactly the European one. So altogether, it's true that the perception when we talk to commercial team, and you hit the point. I mean, when we talk to commercial team, everything is lovely, and the problem starts when commercial guys try to explain the contract to finance guys. So finance guys, we used to take the contract and we see risk everywhere, especially in terms of course, country, of course, the counterparty risk, because most of the time we don't have tracking with these clients, and we see that can be a default or we can be in delay regarding collections. And at the end of the day, all these projects, we are in full competition with other corporates, and in all these projects, the price and the conditions offered to a client are key, but most of times are very, let's say, under pressure and with a very tight margin. So if you have any delay in collection, the cash curve will be negative. You will be in full exposure in different currencies, and it will be a disaster for the parallel put of the project. So taking care of all these projects in different countries, in countries in which you don't feel at home, to be honest, and with other banks, with most of time instruments that are really, that show the lack of trust between the parties, because a letter of credit, as per finance, a buyer's credit is you implement it because you don't trust absolutely that the other party is going to pay to you on time. So, at the end of the day, you put together the country risk, the counterparty risk, and the FX, and it's difficult, and especially with huge projects with a few tickets, because in this project you don't have let's say monthly collection and linear collection. You have big tickets, and if you are in trouble with one of these big tickets,
you're in serious trouble.
Exactly. The cash impact will be terrible. Everything will be delayed. Your suppliers, your global activity, you will enter in penalties. So at the end of the day, it's a mix, and it's a mess just managing all together. And to be honest with you, it's very risky on finance side. It's a very risky situation. We prefer, projects at home and with domestic banks, domestic clients, and so on. But unfortunately, we need to do that because the market is there. So.
Of course, yes. But now, Jose Carlos, let's tackle the FX angle with a little bit more detail. At Camtox, we're fans of the notion of what we call the FX risk map. So, for example, taking a transaction, we'll see the pricing risk, and then the transaction risk, the accounting exposure, and all of that. Describe to us, if you could, the FX risk map of a large cross-border investment project. I understand that there is that time lapse, right, between the moment a bid is submitted and the moment where it's approved or rejected. Tell us a little bit more about this.
Exactly. I mean, the big problem is that we are talking about big projects in which most of the players involved have different interests with very, let's say a strong pressure in terms of pricing. And finally, you need to build one only bid with all the different parties together, different currencies, and you should meet the bid that will be firm, and you need to keep this price during some time up to awarding the project. And the problem is, imagine, I mean, most of the time, I remember in some wind projects in energy, in which you have the cash in one only currency, and the final bid need to be sent in one only currency, but the sourcing was in 5 different currencies. The domestic one, US dollar, Canadian dollar, euro. So at the end of the day, you need to put together all this exposure. You need to put together all this cash curve. You need to choose one exchange rate, and okay, what happened? You put the bid, and theoretically, will the total tender period will be roughly 1-2 months. Not true. Finally, you are talking about 4, 5, 6, 7 months. During this time, you are in volatility, and the other potential, let's say, choice you can take is, okay, I will cover these risks. I will enter in an option, or I will try to manage a multi-currency offer. Not always accepted, but you can buy an option. And the problem is that finally it will be a cost, and everybody needs to accept that if you don't award the project, you will lose this amount. So finally, the biggest problem, the main problem with cross-border infrastructure bids is the time that you need to manage between the firm price and the final award of the offer. So, this is the main problem. 3-4 months in which you are in full volatility, you need to cover all and to hedge all the different risks, including political risk, and nothing else you can do more than spending money and buying an option that is not always cheap. So this is the main problem. And and finally, and this is a good point as well, you need to deal with all the different players inside your organization, and they need to be fair with you. They need to put an acceptable and reasonable price. And the problem is that most of the time, commercial guys and people in your own company, they want to award the project. That's all. And afterwards, the problem with the total cost will be on your side as finance. So,
right. Yeah. You just described, of course, the perennial problem of the currency mismatch, right? You fund assets in a hard currency, but these assets are going to produce cash flows perhaps in not such a strong currency. But you describe something that is interesting, that is often forgotten. There is a governance angle to all of this, right? The relationships that you have to manage and all the different stakeholders. Is that right?
Right. I mean, and when you talk about the stakeholders, you have your own in-company stakeholders, but you have as well banks, public institutions like the export credit agencies that play a big role on that. And of course, your client and or your suppliers. Imagine when I was part of Duro Felguera as CFO, your clients who used to be big corporates, very big corporates, bigger than you by far. And the problem is that your suppliers were, enormous. I mean, right. You are in touch with very big corporates supplying combined cycle turbines and so on, and finally you have no possibility to put pressure on both sides. I mean, you are in the middle, you are like a kind of sandwich, and at the end of the day, you need to accept everything, taking all risks and trying to pray for, let's say, nothing bad happens. That is not always the case.
Absolutely. Now, Jose Carlos, we are interested more and more, I have to say, at Cantox about Latin American currencies, and the immediate thing that comes to mind is the sometimes very, very significant interest rate differential between, say, the dollar and the euro on the one hand, and those, say, Mexican peso, Brazilian reals, and others on the other hand. Now, at Cantox, we've developed lots of solutions to try and sometimes take advantage, sometimes protect our companies from those interest rate differentials. And these solutions are developed in terms of pricing, hedging, FX swaps, and others. How do you go about and manage the problem of sizable interest rate differentials between Latin American currencies and, say, the euro?
Yeah, one of the, just briefly talking about the different issues we find in terms of cash management, liquidity with these kind of operations and big projects. I mean, on the one hand, you have a very expensive cost of funding at domestic level in LATAM. It's the case. I mean, even if you talk to the same bank in LATAM, pricing is double if you compare with Europe. So at the end of the day, you need to look for a good way to fund this project without entering in domestic deals that will be extremely expensive. This is the first topic. So one solution can be, of course, implementing a cash pool and funding the subsidiaries in LATAM from your headquarters in Europe or in other regions that with an acceptable cost. Okay, the problem is that cross-border cash pool between LATAM and Europe is not efficient. So the main problem you have is you need to implement a cash pool. It will be efficient if you do it regionally, but cross-border with Europe, neither with US dollar and euro. So it's quite difficult. So first thing, you need to try to fund your subsidiaries at an acceptable price, and it means not getting in touch with domestic banks, because if not, the cost will be terrible. So this is the first barrier that you need to cope with. Second, transactionally, it's not SEPA, it's not Europe, it's not as easy as managing a credit transfer between Germany and Spain or France and Germany. No, nothing to do. I mean, you will need to take care of the different, let's say, clearing houses, the corresponding banks, the float between different countries when you send money, and chasing where is the money, because finally it's not automatically managed like in SEPA countries. So it's much more complex, either in terms of instruments, I mean in terms of cash management, direct debit and credit transfer, or in terms of clearing houses. So my first advice, and this is what happened, because finally you only learn when you make a mistake. And the problem is that, you cannot implement a very big project if it's the first thing you do in the country. I mean, so you need to learn, you need to start in a new country, especially in Latin countries, with, let's say, medium-sized or small projects. You need to understand how it works. You need to understand how the banking system works and the clearing house work. Afterward, you will be able to understand the whole picture and implementing big projects. But, most of the time what we do is, okay, I have awarded a lovely 1 billion euros project, but the problem is that, the disaster can be huge, and it will be, it will jeopardize the company situation, and you can be in trouble because of a big project in a country that you don't know. So this is the second point. I mean, understanding the legal framework in terms of liquidity, cash management, central bank, and so on. And last but not least, the political risk. Political risk, to be honest, when we implement projects, cross-border projects in, let's say, not first-level countries, in terms of risk, that on the one hand, profitability of the project will be higher, for sure, but the country risk will be higher as well. So hedging this risk is possible, but it's not for free. I mean, you need to get in touch with the insurance company, you need to get in touch with banks to hedge the FX risk, and last but not least, with the export credit agencies and the financial institutions and public institutions that are able to do that, but once again, not for free. So it's know-how.
Jose Carlos, we'll discuss political risk in a couple of minutes, but I think we have already lots of learning here to absorb from what you said. I really like that idea of not going straight for the billion project, but learn by doing, maybe on a lighter scale at the beginning, and then you go on as you learn. Before discussing in more detail, political risk, such an interesting topic, let me ask about your views on Latin American currencies. And when I say this, it's not really about a forecast for exchange rates. It's mostly, as you said, the institutional aspects, the liquidity conditions, the availability of instruments to hedge, and so on and so forth. What's the outlook in your view? Of course, it's such a big continent, right? There's going to be many different situations.
Yes. To be honest, the first and the starting point on my side used to be, landing at country level with a partner. That, in my understanding, used to be and is better if you look for a financial partner. So I mean, for instance, with you, for instance, with a friend bank, with someone that will be together with you to understand how everything works and will help you to understand and to hedge the different risks. This is the first point. And in fact, understanding the how to manage an operation or a project in a country is not only understanding the legal framework and the political risk. It's understanding the habit. It's understanding how banks work there. It's understanding what happens if you have to claim for something, or you have a problem with a specific bank. If they accept a phone call, if they need something written, it's understanding the files they can receive, the format of the file. So for all that, you need, let's say, a partner close to the market and with experience in the market. So it's true that, for instance, not only with you, but with many other players, you feel comfortable and you go together. And you have someone to talk about the different problems and to get an answer. If you try to do it by yourself and discovering over the field how to proceed, I'm not optimistic at all.
Really interesting. Jose Carlos, well, let's discuss a little bit in more detail political risk, or what you just said. Some really interesting. So you made some interesting remarks there. It's such an important topic. If you think in terms of corporate valuation, of course, companies are going to be active as so on the contracting side in some countries, on the selling side in some others. So there is no way to avoid the issue of country risk, such a hot topic. And for treasurers, of course, it involves problems with cash repatriation, maybe changes in business models to adjust to the currency risk, accounting, so elements there. Let's discuss definitions and measurements broadly. Jose Carlos, how would you define country risk, let's say?
Good question. I mean,
or is it important in your work? That is the sense of my question.
No, of course. I mean, when you talk about political risk and on a finance point of view, and don't talk about standard definitions or whatever. What you put together many things. I mean, maybe you are talking about political risk, but at the same time, you are talking about counterparty risk. You are talking about regulatory risk in terms of if domestic clients are very protected, or if foreign companies are not as protected as expected, and so on and so forth. But what is quite clear is that you need to, first of all, to do your own homework. I mean, your own homework is preparing a realistic cash curve about the project, in which the commercial team that used to be close to the client and they need to understand and being, let's say, realistic about what will be the client answer if something happens. They need to prepare a real cash curve in terms of collection, and you need to do the same internally with the suppliers and with the different players in terms of cash out. With this cash curve that should be close to not the best case, of course, and neither are let's say a regular case. It will be let's say quite close to the worst case to see what happens if things are slower than expected.
Right.
With all that, if you see that you feel comfortable,
sort of worst case scenario planning, right?
Yeah, exactly. I mean, it's not a mitigation plan. It's what happens if things are not as expected. I mean, are worse than expected, but it's not enough to claim and to say, okay, I stop the contract. And nevertheless, you can do that. I mean, you can stop the contract, but you can only stop the contract if you are cash positive. If you are cash negative, if you have spent a lot and you haven't collected, you cannot stop the contract because you are in a cash negative position and it will be losing money. So first of all, is preparing this cash curve, knowing and placing different milestones and different collections, doing the same with the cash out, and feeling comfortable with this curve. If you feel comfortable with this curve, you stress this curve, and you say, okay, listen, I can survive with all that, it will be the best mitigation plan to take care of political or whatever risk. I mean, being realistic, giving a acceptable and trustable cash curve, and saying afterwards, okay, the company can survive with us. Because you will be ready for the worst case. Afterwards, everything that will happen will be better, good, or fantastic. We will see. Right. You know, so maybe it's very prudent, but to be honest, real case is that when you try to put the base, you know, the let's say the contract case with all the milestone collection payments and so on, and you get this cash curve, it will never happen. It will be worse. Things are worse than expected, always, always. In big projects, it's like that. If you have a margin, a assignment margin of 30% EBITDA, be sure that will be 20%. It's like that.
Yes, really interesting, and it's nice to see that you take that empirical approach. And correct me if I'm wrong, but if I understand what your words correctly, you say put more emphasis on cash flow calculations and projections than on discount rate theoretical projections. Is that right?
Exactly. Right. You hit the point.
Okay. But hey, let's talk about those discount rates. Do you use any of those measurements, like surveys, say from the VDEM in Sweden, the World Economic Forum, or the Hermes country risk reports, or do you go about and take a look at, say, currency or credit default swaps, CDS, or the country risk analysis of the Moody's, the Standard & Poor's, and the Fitches? What is the view that you take when you need to go about and come up with those discount rates?
You know, just to measure the risk and talking about the specific countries, to be honest with you, what we used to do, and when I was part of the corporates I told you about, is using the let's say the risk managed by the OECD and finally the one affected by the export credit agencies and the public institutions. Why? Because at the end of the day, I mean, if you need to talk to your board and you need to explain and to justify why you are doing something in a country, you will look for let's say the best scenario and the best report in line with what you have done. But if you finally need to take a decision, to be honest, the best way to proceed is taking the report and the country risk calculation provided by the export credit agency that is working with you. Because at the end of the day, first of all, if they don't accept the risk and they put trouble on they see that it cannot be accepted, you are not going to get the project. This is the first point. And secondly, they used to be right. I mean, when we talk about the Spanish risk, for instance, time ago, and they used to tell me, okay, it's not acceptable that we have in Spain the same risk that some Latin countries. Listen, at the end of the day, it was true. We had a similar risk. It's true that right now it's better, but at that time, it wasn't, let's say, so far from real case. And reality is like that. So the public institutions, the export credit agencies, and the different OECD institutions, they used to be quite close to the real risk of each country. Afterwards, you need to sell something to the board. You will have 100 reports and so many players to tell you about the risk, and you will use the best one in line with your own purposes. But I prefer just to use reports more in line with the real case and the real operation.
Absolutely. Jose Carlos, let's discuss a little bit another notion that is close to our heart, the multi-currency world. Recent Bank for International Settlements paper mentions the surprising fact that local currency bond markets are developing at a quite an extraordinary and surprising pace in some countries, not everywhere, but say in China, in India, in the Philippines, in Thailand, and close to home here in Poland, but also in places like South Africa and Brazil. Is that an encouraging sign?
Yeah, you're right. And in fact, this is in some countries, and South Africa is a good example. It's true that developing this market and getting, let's say, an active bonding market in some specific countries is really important, because it's the only way to try to cope with this high pricing of funding in all these markets. So I think that developing a very active, let's say, secondary market and primary market in terms of funds is good news, because it's the only way to fund different projects and to get local funding. If not, taking consideration the problem for the cross-border funding and what we talked about before in terms of cash pool and so on. If not, it's quite impossible just financing a project in specific countries like the one we talked about. So I think that this is something, but this market conditions is competition, and is the trend of the different players right now. I mean, I think that Europe and other other regions are not, let's say, a lovely market, because it's a very mature market. And right now, other markets they start developing their own bonding capacities and their own financing domestic capacities, and this is good news. So when we say maybe a good target for an infrastructure company is a country in which they need energy, or they need railways or whatever. Yeah, I agree, but you need to take in consideration if they have a domestic funding market, possibility to issue a bond, if you can, and this is good. And I think it's it's good news just getting all these new possibilities to fund domestically different projects.
Absolutely. Now, Jose Carlos, we're running a little bit out of time, but I cannot resist to ask you a question on this de-dollarization talk. We are a little bit skeptical in the sense that almost all trades in the 7.5 trillion a day currency markets have the US dollar on one side. So we're a little bit skeptical, but we do like the fact that, in line with what you just said, that there is more and more of, especially thanks to automation, right? To automated tools such as multi-dealer trading platforms, more use of currencies such as the Canadian dollar, the Singapore dollar, the Norwegian krone, the Swedish krone, the Korean won, and all that. Do you have a view on this de-dollarization talk?
I think, to be honest, for a treasurer, I think it's good news. I think it makes our life easier. I think that, globally speaking, for macroeconomics, is not good news, and I think that it will, on a macro point of view, it will be a problem for some countries that will lose instruments to manage their own problems. But the dollarization process is something that, in my understanding, maybe I'm wrong, cannot be stopped. For big multinationals and big corporates with presence and projects everywhere, is good news, in my understanding. And because, once again, because it makes our life easier. And finally, we can take care of this risk in a more efficient way, and without a complexity that is difficult to manage in big corporates.
Absolutely. It's what we call embracing currencies, right? Selling more currencies, selling the currencies of your customers, buying the currencies of your suppliers, reduce costs, and everything is going to be a win-win situation. Jose Carlos Cuevas, partner at Crowe and board member of Asset. We've covered a lot of ground. We started out this conversation with cross-border energy and investment projects. We then went on to a lengthy discussion of country risk, and you gave us an empirical view there of what we need to know about country risk. We then just concluded with some comments on the multi-currency world we live in. Is there something you would like to add?
I think one only thing. First of all, I enjoyed these 25, 30 minutes with you, because in fact reviewing all the complexity of the cross-border operation is funny and interesting. You know, and after talking about all that, you notice that corporate treasurers with multinationals acting and being active in different countries and different regions, the complexity of the job and the risk they are taking and how they are able to manage all that is surprising. So I think it's a value added for our profession when you see that you might need to manage liquidity in huge projects and multiple countries. So I think it will add to our profession and the company some value added, because most of the other departments, they think that treasurers are the one who pay and that's all, and it's not the case. We are the one who manage risk.
All right. So Jose Carlos Cuevas, again, thank you very much for joining us today on CurrencyCast, and we'll see you next time.
See you soon. Many thanks for your time.